Hi, good morning, everyone. Hope your weekend's off to a great start. This is Sean with Paycheck the Portfolio. Today, I'm going to talk about the market crash cheat code, and we're going to talk about some stress tests and visuals and options Greeks, how to place those trades, and additional resources. If you're new to my channel, all of my W 2 income rolls into a brokerage account. I don't use a traditional checking account or bank account. Essentially, what I do is I buy long term growth stocks, closed end funds, and high yield funds with my fully invested paycheck. What that equates to is dividends and growth. And with those dividends, month after month, year over year, as they snowball, they'll eventually overtake and erode my living expenses, which will set me free from a 9 to 5 job. We refer to that in the community as FIRE, which stands for Financially Independent Retire Early. That term's been around a long time, and I'm simply sharing my system for how I'm trying to achieve that financial independence. First, I'm going to jump into portfolio update. Like I do every week, you can see my net account value is currently sitting at $147,512. My total unrealized gain is sitting at $34,639. My day's gains from Friday, we had a pretty good bounce back day, was basically $1,500. Last week was a little turbulent with a couple days of pullback after the rate cut decision by the Fed. And the market's trying to find its new normal coming out of that with additional data points that are coming around inflation, essentially. If you look at my year-to-date performance, I'm sitting at basically 34%. The S&P is at 11, the Nasdaq's at 14, the Dow's at 7.5, and the Russell's basically at 8.5. If you look at my 1 year performance, I'm sitting at 45%, we'll call it. The S&P is basically getting close to 16%. The Nasdaq's at 24, the Dow's at 9, and the Russell's basically at 9.5. If you look at the 3 year performance, I'm sitting basically at 99% cumulative return there. The S&P is at 71.5, the Nasdaq's at 96.5, the Dow's at 50, and the Russell's at 35.3 there. What this accounts for is what we call time-weighted return. Most institutions use that to show you how well your portfolio is performing outside of inflows and outflows of cash. And it takes into account dividends. So this only accounts for, again, the growth of the portfolio and any dividends received. The historical values tab in E-Trade accounts for inflows and outflows of cash, as well as any growth in the portfolio with that spending in account. So if you go back a year in my portfolio, this time last year, last October essentially, I was sitting at a net portfolio value of $105,402. You can see I'm currently sitting at $147,533. That's a $42,000 increase over the course of last year with me fully living out of the brokerage. All of my transactions get deducted directly from my brokerage account. All of my bills are paid through the brokerage account. And you can see that my portfolio is growing and compounding even with that spending. Jumping into the market crash cheat code and looking at the stress test here, options can be a complicated conversation to have, and I'm going to do my best to make this simple and easy for folks to understand. There's things called the options Greeks that I'll talk about as we go along here: delta, gamma, theta, vega. Basically, what delta means is how much the option changes when the stock moves. Gamma would be how much delta changes when the stock moves. Theta, how much value an option loses each day from time passing, or time decay, essentially. And Vega, how much an option's value changes when volatility changes. So I often get asked, how much insurance do I need to insure my portfolio? There's no perfect mathematical equation you can assign to each one of these Greeks because you don't know how afraid the market's going to be at any given point in time. I'm going to go through why this matters and how I manage put options specifically for myself and provide you some calculator tools there that you can look at on your own. But I wanted to touch on the Greeks there because we don't know how afraid a market might be. We don't know how quickly prices will move and how fast those prices will move. So when I'm talking about put option insurance, I'm not looking for the perfect hedge. I'm looking for an airbag in a car accident type of a situation that allows me to be okay and to essentially regroup and potentially rebalance if needed and stay in the game and continue to compound my money, right? So if you look top left, I have market drops here from 0 to 30%. Basically, what you'll see below is total protection of my current put options with a hedge. So we'll go line by line here. It's going to take me a little bit longer to go through this so everybody hopefully can understand. But looking at 0, basically my gross portfolio value is sitting at $301,000 there. My net account value, and this was last night before my dividends roll in. So if you see a slight difference between what I showed on my historical values and the net account value here, that's because dividends rolled in for me overnight, my weekly dividends, and it increased my net account value. So I worked on this file yesterday. But net account value would be 146,000. Current SPY price is 662. Current QQQ price is 596. I currently own one SPY contract with an expiration date of October 31st, 595 strike price. I own one QQQ put contract expiring 1031 at a 495 strike price. I applied a 15% volatility just to kind of see a normal range there. So you can see prices move with that implied volatility change. So looking at a 10% drop, you can see what would happen to my gross portfolio value there without a hedge, my net portfolio value without a hedge, what the SPY and QQQ movement would look like, and essentially what would happen to those put options contracts. And so that contract price is going to move with the Greek calculations and the implied volatility and the time around that volatility. So in this stress test, I'm talking about if the market dropped 10% next week, this is what these values would look like. Same thing for 20%, same thing for 30%. So in this case, if we drop 10% next week, my put option that cost $179 to open would now be worth over $1,000 worth of value, which would insulate me from that drop. My QQQ contract would now be worth $965. This assumes a 30% IV, which is pretty common historically with a 10% pullback. Looking at 20%, you can see the value changes here. I won't go through each percentage drop, but you can see on the screen. Basically, what happens to the put options contract in that situation is it becomes more valuable the steeper the decline gets because those contracts become very valuable. So in this case, my initial 179 investment would now be worth $3,638, and my QQQ contract would be worth $3,634, and that's with an implied volatility of 45%. With a 30% drop, you can see that it starts to become very valuable, and the further it goes past that, it's just going to increase exponentially. So with a 30% drop, that 179 is now worth $7,116, and that 102 is now worth $8,132. That takes into account an implied volatility of 70%. Again, this is assuming these moves would happen next week with a time decay scenario. So if you look down here below, and I'm going to have this Excel file in our Discord community, which is part of our membership, so the members can look at this and play with it with their own numbers, but that will be available. So if you look at the market drop, you can see my total protection when you take into account all of my two contracts essentially on both SPY and QQQ. You can see my gross portfolio value without a hedge and my gross portfolio value with protection, my net account value without a hedge, and my net account value with protection. So obviously, it starts to become very valuable as the market drops, and the market drops substantially. A few rules I follow. I always maintain 50% or greater equity in my portfolio. That provides me a layer of protection, and so I'm not over leveraged. I always keep put options on, as I'm showing you in this Excel file, which insulates me from a market correction and a market crash. So maintaining that 50% equity, my W-2 income is rolling in every 2 weeks, which allows equity to continue to climb. My dividends hit like they did last night. which allows my equity to continue to build. And I rebalance if needed. We'll talk about that and how there's a cheat code you can use if you get into a margin call type of a situation. Just as a footnote here, in high volatility, I add cheap weekly put options as an additional layer. I'll go 3, 4, 5 days out. And basically, you can see I did just a mock-up of what that would look like in the same scenario. So let's say next week we dropped, or it sounds like we're going to drop, and it's going to be a clearly trending market that's obvious, very similar maybe to what we had with the tariff situation. If you bought SPY with an expiration date of October 1st, and I picked 654 here because the contracts are a lot cheaper in those shorter time frames. So if you take that into account with a 10% drop, you can see that would be worth 5,400, 20% drop 11,700, and a 30% drop basically $18,000. So when the market's highly volatile, I want you to envision how my brain would work in this. I already have these put options on at all times. That's a base layer of protection. I'm always keeping 50% equity at all times with the inflows of cash. And then in highly volatile markets, I start adding a layer of weekly put options as well, which would further insulate my account and protect me in an extreme environment. So that's how you can apply that for yourself. So here's a cheat code that's a really cool tip. If you're forced to sell a high maintenance position, there's some margin maintenance requirements within your brokerage. And there's some holdings, usually Bitcoin type of holdings or different asset classes that are high volatility, that your brokerage will require 100% margin maintenance. What that means is if you invest $1,000 into a 100% maintenance position, they hold $1,000 of your equity within that position. Let's say you're in a margin call or things are getting a little sticky for you. What you could do is sell that $1,000, which would immediately release $1,000 of equity. You could turn around and reinvest that equity or a third of that equity into TQQQ and or UPRO or both. When QQQ goes up 1%, TQQQ goes up 3%. Same thing with UPRO. When SPY goes up 1%, UPRO goes up 3%. So you can release equity, which keeps you safe, and invest a third of that equity back into these triple long positions that allow you to maintain a bounce back or an upside potential while releasing your equity. So you keep the upside bounce potential and you free up equity at the same time. So this isn't meant to be a perfect one-to-one follow this exact example. This is meant to show you how layered, wise application and portfolio management can insure you against a market correction or a market crash, and how you won't get liquidated and how you'll get out of it okay, and how you're able to bounce back stronger after that. If you look at the visuals, basically what I have here on the left is the gross portfolio value with no protection, which you can see with the orange line, and with gross portfolio value with protection. Obviously, the further the percentage drops, the more valuable those put options become. And that's just with the one contract of SPY and the one contract of QQQ. And you can see the net portfolio value down there with no protection and protection. Again, that assumes you're maintaining the 50% equity along the way. That way you're making sure that you're safe at all times. On the right, you can see the hedge value at different market drops. So obviously zero self-explanatory. At a 10% drop, those two contracts become potentially worth $2,000. 20% above 6,000. 30%, you can see it gets north of $15,000. So that's how a hedge helps insulate you from a market correction and a market crash. We talked about the options Greek, so let's start with delta. How much the option changes when the stock moves. So shows you how much speed of protection you're getting. The way I apply this is off to the right. It's not essentially a one-to-one to the Greek, but we'll go through that at the very end. Gamma basically states how much delta changes when the stock moves. So puts get stronger in fast crashes, weaker in slower drifts. So that's in fast crashes is what I'm worried about. That's what allows me to sleep at night. In slower drifts, I'm getting my W-2 that's constantly coming in. I'm getting my dividends that are dripping and being paid in cash. and there's a constant cash flow cycle there. So those things worry me a little bit less than corrections and crashes. Theta, how much value an option loses each day from time passing. This is what we would refer to as time decay. The insurance premium you pay to carry protection is basically highly allocated to this time decay model. So that's the hardest thing to predict is time and fear in the market. In Vega, how much an option's value changes when volatility changes, basically implied volatility, often and quite frankly aligned with the VIX chart, which you can Google in and see the historical VIX movements there. So in panics, volatility spikes and puts become more valuable. If you want to look at how this would impact you on a calculator, I will have this link in the shared file that I'm going to have on Discord that you can get to, or you can simply type that into your search bar and it will take you to an options calculator that shows you how valuable these options contracts become in certain environments. So how do I manage put options? I buy 30 days out. I always have that on at all times as my base layer of protection. I buy 10 to 20% out of the money. What that means is below the current strike price. I roll my contracts approximately 5 to 7 days before expiration. I expect to lose money on these contracts. I look at them as homeowners insurance policy. And if I'm losing money on these, that means my gross portfolio value and my net portfolio value are growing. And I look at it as a cost of doing business, but they're always on, and I roll them 5 to 7 days before expiration. Again, you can look at the VIX chart, which shows you the volatility in the market. I try to buy my put options when volatility is low because that means the options contracts will be cheaper. Again, in high volatility environments, I'll add weekly options as an additional layer just to protect me even further, and you can do the same thing. Some people in my community and the members, they don't get options level 2. I wanted to call this out, that you can apply SQQQ and SPXU as well. These are the opposite of TQQQ and UPRO. So when QQQ goes down 1%, SQQQ will go up 3%. When the S&P 500 goes down 1%, SPXU will go up 3%. So if you don't have options contracts level 2 in E-Trade or other brokerages, you can simply adopt SQQQ and SPXU. But to me, the most effective hedge is having options on at all times, and that's how I manage it. Looking at how to place a trade, and I'll show this in E-Trade, I have these images so you can see basically you would go into the portfolio trading, you would click options, you would click the symbol SPY, you would click select the strategy put, you would hit buy to open. In my example, it's one contract, expiration October 31st, 2025, strike price $5.95. And it would tell you basically the market price for that right now is $115 because the market was up Friday. And we're in an after hours environment. But that's what you would do to buy one contract of SPY. For QQQ, same exact thing. You put buy to open, one contract, October 31st, $4.95 contract. Market price for that would be $73 currently. And so the way you would do that in E-Trade, again, you would go trading, options. You would type in the symbol here, just as an example so you can see it. You would click put, and then you would select the contract from this point, 1031, 10 to 20% out of the money or below the strike price. And that's how I'm working my initial layer of put option contracts right there. So if this has been helpful, and I hope it has, so you can come up with your own hedge strategy, I have all of my resources pinned below all of the comments on YouTube. If you go to my YouTube videos, it will be pinned down here. You can simply click on these resources and in the description of every video. But basically what I have is a free starter kit that tells you about my system, what I'm doing, and gives you a simple Excel file that you can punch in your numbers and see how your gross portfolio value and net portfolio value would grow. Essentially, you can book a one-on-one strategy call with me. That's a 30-minute call if you want to talk with me more about the system and how it works. We have a private Discord and membership, which I'm going to show you, and really intelligent community and folks that we have tools. I'm going to show you that here in just a second. And then you can set up white glove coaching if you need shoulder to shoulder strategy and you need my help setting up my system and me showing you exactly how I do it for myself. That resource is available to you as well. Looking at the Discord membership, just so you can see, we have tools in here, calculators. My portfolio is updated every week. You can schedule strategy calls within Discord. We have live meetings every week that are recorded and private to the community. And again, we have very intelligent members. And Rob is a gentleman I talk to quite often, and he's really good with options trading and contracts. So he has a thread below our options resources that he actually shows you and teaches you how to use Thinkorswim and apply your own hedge strategy and essentially forward test what your portfolio would do in any type of market downturn or correction, just like I showed on my Excel file. And so all of these resources are available if you'd like to join the membership and the Discord access there, and just wanted to show you some of the tools at your disposal. Again, I hope that this has been helpful for you. I know it can be a complicated topic, but oftentimes I'll get comments about how I'll get liquidated, how it's great in an upward market. We just went through a market correction in April, and I'll leave you with this. My put options kicked in, and I was actually buying in April. I wasn't selling. The put options hedge allowed me to continue to buy without panicking. You can see during the April tariff situation, I was actually buying this NVIDIA that whole month, essentially. And you can see when the market rebounded how well I did on that. So when I say that I don't lose sleep or I'm not afraid in those situations, I'm showing you transparently what I actually did in the month of April, which you can see I was buying NVIDIA and I was buying TQQQ and UPRO during those April times. I was buying and selling from them as things were moving. And you can see what the result was there during tariffs. Same thing with UPRO coming out of that and the rebound potential that gave me. So again, you don't have to worry if you know how to manage your portfolio, but I beg you, if you're living out of your brokerage like I am, please make sure your account's protected and that you're applying these principles wisely. If you need any help, feel free to reach out to me. Hope you guys have a great rest of the weekend, and we'll talk to everybody soon.